Hey everyone, it's Matt with EquiPredict.com. Thanks so much for tuning in. In this video, I'm going to show you how to use a very effective, very profitable, if implemented correctly, three moving average trading strategy that you can go ahead and deploy right away on just about any software platform that's available, even those free ones out there like Yahoo.com. You can go ahead and put this into practice right away. Again, I just got to emphasize that it has to be done correctly or else it will not work. So make sure you just understand each step of this video, and then we'll hop right into it. And again, if you're enjoying some of the content we're providing, please do subscribe to the channel. You can also head over to our website, EquiPredict.com. There's a whole bunch of information over there that will help you with your trading strategies as well as some market updates to keep you abreast of what's developing in the market, as well as the forecasting model that we use. So up on the screen here, we've got a chart of Hubble. We just recently used this on a different strategy. In this particular one, we're using Hubble because you can see here on a monthly time frame, it's in a nice uptrend. You can't deny that. We're coming to a pullback area right here, which I'll just highlight as we approach, or as we're into July of 2024 right now. But the three time frames that we're going to be using are an 18, a 40, and a 190 period moving average, and each one of those is a simple moving average, or SMA. We're going to keep that just as it is, because these three moving averages, I should say, are very effective for a lot of folks out there. They're very effective for me. You might have some adjustments to ones that you use, but these three work for my strategy, and that's why we're going to use them. So we're using an 18, a 40, and a 190. The red line is your 18. It's your faster moving average. 40 is the green one. It's a bit slower. And obviously the purple line down here is the slowest of the three. That's your 190 period moving average. And what you want to do is, in a nutshell, again, recommend following each one of these steps in the video. We're going to be covering four time frames: monthly, weekly, daily, and hourly. But what you want to focus on is that the moving averages are all in agreement. They're all pointing or are pointing in the northeasterly direction. You want them pointing upwards. You really want to make sure they're not pointing downwards. One thing I do need to emphasize is that price action is your ultimate guide. The moving averages are lagging indicators, so they're not leading, obviously. They're going to be lagging, so they're always going to give you a picture of what has already happened, not what is happening. But you can participate as soon as they start to turn up on the smaller time frames of your choosing, and I'll kind of show you that. So first thing I want to point out here on the monthly chart, and you can point these on any chart, but you have these air gaps in between the price action and the 18-month moving average. These air gaps you need to be kind of cognizant of. They typically indicate heightened risk as you get overstretched and too far away from any kind of 18-period moving average, because price oftentimes likes to come back down to an 18. It's just something that's been true for many years. But those air gaps you just want to be aware of, and just if possible, you want to wait for the price to come back down on the smaller time frames, or at least in a larger time frame, to that simple moving average 18. And that's exactly what's happening here with Hubble. So on the monthly chart, we are coming down. Is it going to meet the 18? There's a lot of demand in the technology space, so I would have to say I don't believe that would be the case this particular time. Maybe later on this year it might, but as you can see, it started to go kind of parabolic really since 2020, and that usually resolves to the downside. But nonetheless, we're going to hop down to the weekly charts, and I'll kind of explain as we get more into the weeds what to look for on the smaller time frames so you can pick your entry. So the next screen is going to be our weekly chart, and as you can see, the 18 and the 40 period moving average, these are 18 and 40 weeks, gets busier. They get more choppy, and that's totally fine. That's all right. I think it's Alexander Elder who said that when price enters sort of between the two of the faster moving averages, that's your value zone. That's where you want to start to look at picking up shares. And that's exactly what you can see here on this weekly chart. Anytime it's really come down into the between the 18 and 40, or the value zone, it's a good time to pick up shares, to buy shares in the stock of your choice, and that's what's happened. This is sort of that value zone. So again, it's more of a risky speculative zone, because it could collapse further and head back down to a 190 or even further. But nonetheless, these are areas that you want to be looking for your entries, and that's kind of what's happening here with Hubble. If you look at this, it's in the value zone. Now what we want to do is we want to attempt to find our entry on the lowest time frame that we're comfortable with. In this particular case, we're going to use the hourly. But right now on the weekly time frames, what you see is 190 period moving average, so 190 week moving average is still rising in the northeasterly direction, okay, to the top right hand corner of the screen. Your 40 is still in moving in an upward direction. However, if you look carefully, your 18 week is starting to curl over, so that's indicating that there is some significant selling pressure just to be aware of. So right away, what we want to do is see this and say, okay, well, we don't want to take an entry just yet. The reason why is because you want your entries, you want all moving averages to preferably be pointing to the northeast. You want them all to be pointing to the top right hand corner of your screen on your lower time frames, and in a particular way too as well, and I'll get to that. So right now the rule is broken. We don't have three simple moving averages all pointing to the top right hand corner of the screen, so we're not going to take an entry just yet. So let's hop down to the next lower time frame, which is going to be your daily time frame. So here we are. We got our 190 day, 190 period moving average that is moving to the top right of our screen. You can see, so that still indicates that there's that the time frame is still moving in the right direction, and that there is support here at 190 days. It certainly could break down, but right now that is lending itself as support to price action, and so that's a very good thing. However, if you're going to see, you'll see right now that the 40 is pointing down, and the 18 has just, because it's a faster moving average, it's just starting to curl upwards a bit, because I believe price is closed just above that or just below it actually. So that's causing the 18, but we don't have we don't have a rule yet that's telling us that we're going to be using this moving averages as an entry at the present time, because of the fact that we've got one of them, the 40 period moving average, is not pointing upwards. So we don't have an entry yet on the daily. However, we are sort of still in that value zone. So if you're keeping in mind the larger time frames, you're going to see that the price action is in that value zone on the larger time frames. So we're still hunting and still looking for an entry. So let's hop down to the daily at this point, the hourly. And what we're going to do is we're actually going to be using, you can pick an oscillator of your choice, of your choosing. However, I've chosen the ultimate oscillator because it's one that I use often, not always. I try to use as few indicators as possible, but this one lends itself pretty well to timing your entries on a smaller time frame. And so what we're down here on the 60-minute time frame. And now one thing I would always recommend is when you're on the smallest time frame, always do a double check, head back up to the larger, just to remind yourself that you are in an uptrend, but you've pulled back, see how far you are stretched from the 18. Oops, we're not there just yet. And we're going to kind of look at our hourly chart here and say, okay, are all three rules in play? Are all three moving averages pointing towards the top right hand corner of the screen? And we have a clear no on this. Our 190 period moving average, as you can see, is pointing downwards. Okay, so we don't have an entry just yet. Our 18, which that red one is, and our 40 is flat. So there's starting to be a turnaround, but we have to get through the fighting, the down trending 190 moving average. We need to make sure that is starting to at least flatten out before we take an entry. The other thing we want to be looking at is what the ultimate oscillator is telling us, or any kind of momentum oscillator of your choice is telling you. And what you'll notice is, even with like RSI, in this particular case, this ultimate oscillator with its standard settings, I think it's 7, 14, and 28, you'll notice that the ultimate oscillator has never really gotten above this line, which is around 65, 66. As the price is falling, each little bump up, you're going to see it never actually crests and breaks that number on the ultimate oscillator of 65 or 66 or so. So what we're looking for is we're looking for price to break above this larger downtrend line. We want the 3 time frames to be heading in the towards the top right hand corner of your screen, and we want the ultimate oscillator to pierce above that 65, 66 period, preferably on the lower time frame, become overbought. So once you have all 4 of those ingredients and the downtrend is broken, it's it would constitute a lower risk entry. Again, you're going to be a little bit late to the party. You're not going to be down here with the speculators. However, you are going to be getting confirmation from the price action, the moving averages, and the ultimate oscillator that it's time to go long on this particular stock. And what I like to do is once I'm down here at the 60-minute chart, I like to back up with the 60-minute chart and go towards zoom out essentially. And then what you're going to be able to see is here the price action will dictate when it's time to attempt to go long. You obviously want to have risk management strategies in place. You want to have your stops at a particular point that you're comfortable with. My recommendation is have them a bit further from the market, especially if you're in a bull market like we are now. Just in general, have them further from the market. But what you're going to see is if you take your smaller time frame and then you zoom out using the software that you're using, you're going to be able to see it's very busy. You don't need to, in my opinion, you don't need to get concerned with all the 30 and 60-minute candlesticks that you're going to be using. But what you want to do is wait for price action to start to pierce above that, but also you want all the moving averages to be starting to point towards the upper right-hand corner of the screen, and then you want supporting evidence, which is going to be your ultimate oscillator down the bottom, pierce above that 65, 66 line and preferably become overbought. At that time, you'll be looking for a pullback, or you can go ahead and go long at that time, but just make sure you have your stops at a particular point. One thing I would just note is that this downtrend line, what I like to do is make sure that there's a piercing above a downtrend line that's around a 45-degree angle or so. You know, trying to catch these downturns that are very violent. Yeah, you're going to just, you know, the short seller is going to come in here and they're just going to take you right down and basically take advantage of the fact that you're trying to catch a trend reversal, because we all love to pick up shares at a discount. However, my suggestion is wait for the price to start to move in the direction that you want it to. Have those moving averages all start to be curling up. So I'll draw some of these in of how they might look. Okay. And then you want price to come back down into one of these value zones between maybe an 18 and a 40 on the 60-minute charts. Plus you want the ultimate oscillator to kind of pierce to the upside. One thing I will kind of point out is that you can see here that if you had only looked at the charts to this particular point at the end of May, you would have seen a pop to the upside. But if you look, you had a real strong bearish divergence on the ultimate oscillator, which told you that this break in the downtrend line would not have worked, even though your 190-hour essentially moving average was starting to curl around. You had your 40 and your 18 all pointing in the right direction. However, if you would have chosen entry once you got some confirmation that the price was going higher, always double check your oscillator. For example, the ultimate oscillator here, and if there's a divergence, that's a high risk entry. You really don't want to take one of those. You want to see it test 2 or 3 or 4 times a downtrend line, start to break above. Again, to reiterate, your moving averages are all pointing to the northeast or top right hand corner of your screen. You want your ultimate oscillator to get overbought, and then again, preferably you want to pull back into a value zone on the 60 to start going long. So I hope all that makes sense. And it helps you with your trading strategy. And again, if you enjoyed some of the content here, just please do subscribe to the channel. Also head over to the website EquiPredict.com. We also have a newsletter I believe you can sign up to as well. Take care. Happy trading.